Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Money market. Money market is a market for short-term securities. It is a market for securities that have a short maturity date of up to 1 year. It refers to trading in very short-term debt investments. A money market is made up of banks, non-banking financial institutions, and acceptance houses, and it facilitates transactions for short-term cash while also preserving adequate liquidity in the market. It is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities with average maturities of 1 year or less. It helps governments, banks, and other large institutions to sell short-term securities to fund their short-term cash flow needs. The institutions that offer money market instruments to the lenders, investors include commercial banks, corporations, government, non-banking financial institutions, etc. Features of money market. 1. The money market involves the purchase and sale of large volumes of very short-term debt products. 2. Individuals can invest in the money market by buying money market funds, short-term certificates of deposit, CDs, municipal notes, or U.S. Treasury bills. The money market has retail locations for individual investors. They include local banks, the U.S. government's Treasury Direct website, and brokerages. 3. Money market accounts offer higher interest rates than normal savings accounts, but they have higher account minimums and limits on withdrawals. 4. Money markets include markets for such instruments as bank accounts, including term certificates of deposit, interbank loans, loans between banks, money market mutual funds, commercial paper, treasury bills, and securities lending and repurchase agreements, repos. Types of money market instruments. 1. Money market accounts. Money market accounts are a type of savings account. They pay slightly higher interest rates than regular savings accounts, but they often come with restrictions on withdrawing money or writing checks. Withdrawals are limited by federal regulations. The bank will promptly convert the money market account to a checking account if the limits are exceeded. Banks typically calculate interest on a money market account daily and make a monthly credit to the account. 2. Certificates of deposit, CDs. Certificates of deposits, CDs, are available for short-term and long-term periods with terms of up to 10 years. CDs with short periods is 3 months to 6 months are considered as money market instrument. 3. Treasury bills. Treasury bill is a money market instrument is issued by the Government of India. The bill is issued as a promissory note of repayment in the future. The purpose of a treasury note is to secure funds to meet the short-term fund requirements of the government. It is done to minimize the fiscal deficit of the country. Most of the governments issue treasury bills. The U.S. government also issues treasury bills, which is called U.S. Treasury bills. 4. Interbank loans. It is known as loans between banks for short period. It means loan provided by one bank to another to meet their emergency need of finance. Most interbank loans are for maturities of 1 week or less, the majority being overnight. Such loans are made at the interbank rate. The interbank rate is also called the overnight rate if the term of the loan is overnight. 5. Commercial paper. Commercial paper, CP, is a short-term debt instrument issued by a corporation to finance short-term liabilities. It's a type of unsecured promissory note. It is a market for buying and selling unsecured loans for corporations in need of a short-term cash infusion. Only highly creditworthy companies participate in this market and hence the risks remain low. 6. Bankers' acceptances. A banker's acceptance is a short-term loan that's guaranteed by a bank. It is used extensively in foreign trade. A banker's acceptance is like a post-dated check. It serves as a guarantee that an importer who has ordered goods can pay for them. 7. Eurodollars. Eurodollars are dollar-denominated deposits held in foreign banks. They are not subject to Federal Reserve regulations. Very large deposits of eurodollars are held in banks in the Cayman Islands and the Bahamas. Money market funds, foreign banks, and large corporations invest in them because they pay a slightly higher interest rate than U.S. government debt. 8. Repos. The repo or repurchase agreement is part of the overnight lending money market. It is an agreement to buy back the instrument together with interest within short period after the issue. Treasury bills or other government securities are sold to another party with an agreement to repurchase them at a set price on a set date. Money markets and capital markets. The money market is a market for short-term securities, that is, debt for less than 1 year. It is used primarily by governments and corporations to keep their cash flows steady. It helps the investors to make a modest profit by dealing in such kind of securities. The capital market is concerned with the sale and purchase of long-term debt and equity instruments. The term, capital markets, refers to the entirety of the stock and bond markets. Stocks have no expiration date unless the company itself ceases to operate. Banks, non-banking financial institutions and stock exchanges are the institutions in capital market. Advantages and disadvantages of money markets. Advantages. 1. There is extremely low risk in buying, investing, and selling, borrowing or getting back the investment with interest in money market. 2. In some countries there is insurance initiated by the governments for most of the securities in money market. In US most of the securities are insured by FDIC. The Federal Deposit Insurance Corporation (FDIC) is an independent agency created by the Congress of USA to maintain stability and public confidence in the nation's financial system by insuring deposits. 3. Money market instruments are highly liquid in nature. It can be sold at any time and cash can be realized. 4. It gives higher returns than most bank accounts. Disadvantages. 1. The returns of money market may not keep pace with inflation. 2. There may be restrictions regarding high minimum investments or withdrawal. 3. All money market securities are not insured. When compared to the advantages of money market, the disadvantages are very negligible. 1. The economy will not function effectively without money market.